Hello everyone and welcome to another episode of Common Law and Simple Flow. Today we are going to talk about fourth topic of tax, inheritance tax. Let's start with the introduction firstly. This is a pretty small flow with 163 components. So, what is inheritance tax? Inheritance tax is a UK tax on a person's estate when they die. So as soon as the person dies, there comes a question of taxation based on inheritance tax on their estate. What is exactly taxed? The estate of the person who has died, everything they owned minus their debts, expenses such as funeral costs. So we are excluding the debts and expenses for their funeral, but everything else will be subject of inheritance tax. And the estate will be valued immediately before death. So not how much person did have 2 years ago, but no, immediately before the death. The rate of the tax, which is very important, is 40. Let's connect it with the painting of Edouard Manet, where he painted his friend Claude Monet. So Claude Monet was born in 1840. That's why he is number 14. So in the painting we can see Claude Monet, who paints himself. And he doesn't paint himself, but he's busy with painting, and the painting itself, the original one, was made by Edouard Manet. So the 40% of inheritance tax. Let's imagine a scenario where where Claude Monet's painted was part of inheritance of a very wealthy person. And after the death, everyone, personal representative, the beneficiaries, etc., everyone gathered around this painting to understand how much will be inheritance tax over it. So, nil rate band. The first 325,000 of the estate plus any chargeable lifetime transfers on that use up this band, which is taxed at 0%. Only the value above 325,000 will be taxed at 40%. So to remember this 325,000, because this is the amount that defines your allowance. Only after 325,000 it will be charged. To remember that number, let's connect it with number 3, which is Michel de Nostredame and Margaret Thatcher 25. Together they are 325. How to connect it with the story? So let's say the Nostredame, he has predicted the future, that Margaret Thatcher will burn with her iron this painting of Claude Monet. And as soon as she burns it, the value of the painting decreases and the 325,000 will be basically free of any tax. And also, after burning this, the burnt part, after burning it, was donated to the church, to Jorge Bergoglio, the Pope, and it was the 10% basically that was burned, and it was donated. And the tax rate decreased from 40 to 36. This is easy way to remember, because if you donate 10% of your net estate to charity, the rate on the taxable portion will be reduced to 36% instead of 40. So just to remember, the overall tax for inheritance is 40, and that's Claude Monet's painting. Then the allowance for this non-taxable amount is 325,000, which is Nostradamus predicting that Margaret Thatcher will burn the painting. After the painting is burned, the the allowance rate drops to 36 because the minor part of it was donated. So if you donate 10% of your estate, then instead of 40, you will pay 36% of tax. CLTs, chargeable lifetime transfers. What are they? Mainly, these are lifetime gifts to discretionary trusts. They use our nil rate band, NRB, the 325,000 first. Any excess over your available NRB is charged at 20% when made. If you die within 7 years, a top-up may be due so that the total charge reaches the death rate 40%, which credit for 20% already paid. If you survive 7 years, no further inheritance tax on that transfer, though the trust may face 10-year exit charges. What does this mean? So if chargeable lifetime transfer, these two words are relevant. So chargeable and lifetime. You are transferring your estate, something part of your estate, during your lifetime when you are still alive. And these are basically lifetime gifts to trust. So you are transferring a land, for example, to a trust as a gift. And you are paying instead of 40%, only 20% if this exceeds the 325,000. If you die within 7 years, so this is kind of a proactive approach that before you die, you want to transfer your land or your estate without paying so much tax. Let's say your friend, he wants to leave you a house after he dies, but he doesn't wait until they die. They do this transfer to a trust, which beneficiary will be you. So the trust's main purpose will be to serve you, and he's taxed 20% if the land is 500,000 and not 40%. But he's doing this proactively. If he dies in the next 7 years, he will need to top this up with until 40%. So before it only 20% was paid. Now it will have to be topped up to 40%. But if he survives 7 years, no further inheritance tax on that transfer will be counted. So in case of death, this 20% will be the maximum that your friend paid. If he survives 7 years. There is some question regarding the 10-year exit charges, but this will be discussed. This will be discussed in a while. So just to understand, this is a workaround for not paying 40%. If you do the transfer during your lifetime, not after you die, then you pay only 20%. The half of it, basically. But if you die in the 7 years, then you will have to pay 40%. Now, cash gifts to individuals. This is PET. So this was CLT, chargeable lifetime transfers, and PET, potentially exempt transfer. What they are: gifts to individuals, for example, to your child, are potentially exempt transfers. So you basically, if you're transferring to an individual, this one was transferring to trust, right? Trust is not a person. And you're transferring to trust, and you will pay 20%. But if you are transferring to an individual, like to a child and to a friend directly, for example, that will be called potentially exempt tax. So just remember, it has potential of avoiding any tax. You pay now no tax. If you survive 7 years, then you will be fully free from inheritance tax. You will pay no inheritance tax. If you die within 7 years, the gift uses the NRB first, and NRB is the nil rate base, is your allowance, the 325,000, and any excess on that is taxed at 40%, with taper relief including the rate after 3 years. Taper relief is not so clear here, but what we should concentrate on is that when you are gifting your land to an individual, then you are potentially exempt from tax if you survive for 7 years. So the goal is to survive 7 years. And if you die within 7 years, then you will use your NRB, which is your nil rate base, the allowance of 325,000, and everything after 325,000 will be taxed on 40%. But this 40% will be reduced depending on how long you have survived, because if you have survived longer than 3 years, it won't be 40%. And we will explore those numbers in a while. A failed PET, potentially exempt transfer, is when the donor dies within 7 years of making that gift. So if you gift someone and you are potentially exempt from tax, then you die within 7 years. It means this is a failed PET. Then the gift becomes chargeable to inheritance tax. It's treated as a transfer on death. This uses the nil rate band, which we said is 325,000 first, and any excess will be in a standard way charged up to 40%. And now let's talk about taper relief. Taper relief reduces the rate, not the amount given, if the death is 3 to 7 years after the gift. So this will only reduce the rate of the tax. So let's say father gifts a partnership share worth 600,000 K to her daughter. She dies 3 years later. The daughter kept running the partnership. The gift, a failed PET, qualifies for 100% BRP. It will be 100% qualifying for BPR, business property relief, which will be eventually £0 as chargeable for inheritance tax. So £0 of inheritance tax will be chargeable. And this is the tricky part here, because you may firstly think, okay, the PT has failed, so we need to think of, was there any taper relief? And the table for taper relief is this. So if you die from 0 to 3 years, then you need to pay 100% of the whole tax. I mean, the rate will be 40%. And then it will be from 3 to 4 years, it will be reduced to 32. Then from 4 to 5 years, if you die during 4 and 5 years, then it will be 24. Then for 5 and 6 years, it will be 16. And you're seeing the tendency. It is just firstly being reduced with 8, then again 8, and then one more 8, and then 8%. 6 to 7 years will be just 8%, and after 7 years it will be 0. And this is the taper relief. The rule that you need to remember is that you die after 7 years, you pay nothing. But if you die on the 4th year, it's not always 40%. It will be taper relieved and reduced. And in this example, we say, okay, she dies 3 years later. So that's the question is, like, after 3 years, it was more than 3 years, or it was less than 3 years. And before delving into that, you see that there is another exception. So this is some overlap of rules and reliefs, and this is business topics. So we're talking about partnership, and there is business property relief, which is a fully another branch here. But for your preparation, that you know that something else may come, and it's not always a taper relief from the first glance. So you have seen this here, the taper relief table, and now let's go through this example. 4 years ago, Alex gifted 500,000 to their child, PET. This is potential exempt transfer. Alex dies now, and nil rate band will apply with 325,000. So only everything after that 325,000 will be chargeable, which is 175,000. And now the question is, will it be 40%? No, because the person, Alex, died 4 years after it, and it's more than 3 years, and it will be tapered at 4 years. It's 32%, so 8% less than 40%, and the result will be 56,000. This is usually payable by the child, so the child will need to pay the tax when they inherit the estate. If Alex had survived 7+ years, the PET would be fully exempt. No inheritance tax would be paid. Just again, the table, it's pretty straightforward. 40% tax is always when you die from 0 to 3 years. When it's between 3 and 4, it's 32, 4 and 5, 24, 5 and 6, 16, between 6 and 7, 8, and more than 7, it's 0. Let's now continue with some examples. Parents leave 2.5 million house to their child. Assumptions are here to keep it simple. We are at the second death. Everything passed spouse to spouse first, and then later to the child. So for what does it mean, second death? Both parents should die in order for the estate to fully transfer to their child. If one parent dies, then everything what the second parent owned is being passed to the first parent. So both NRBs are available. This is the inheritance, the nil rate band, and we have 2 of them because we have here 2 parents, and let's say 2 parents died, and now we have 650,000 in total because we have 2 times 325. Full residence nil rate band would be 300K, but because the estate is 2.5 million, let's just roll back and start again. So this is a very complex example. And in this example, parents do 2 things. They leave 2.5 million house to their child. And the next thing they do, this is the second thing, but it's previous thing. They've also done transfers to their child. 500K cash gift 8 years ago, and since it was 8 years ago, more than 7, then it fails. And they also have transferred 800,000 cash gift to 4 years ago, and PET is still within 7 years. So PET in the first case, it helps, the tax is ignored because it's more than 7 years, and PET fails in the second case because 800,000 cash was gifted 4 years ago. And when we see in our table, it's 4 years, then it's 32%, right? So this 500,000 will be automatically ignored from our calculations, and 800,000 cash will be calculated first to understand how much tax is being paid. And the important thing, this NRB, the nil rate band, it can be used only one time, right? If we have the full estate, it's 2.5 million and 800,000 cash, it will be all calculated together, and you can apply it only once. So as we said, this is a second death. So we have 2 parents that died. So we have nil rate band available of 2 portions. It's 650,000 for both parents. And the second thing that we haven't discussed yet is residence nil rate band. And residence nil rate band is a separate allowance only for residencies when you transfer your house. And this is 175,000. It's not 325,000 as our normal nil rate band. And it is 175,000. To remember this number, let's think of Andrew Celsius, number 1, and Pedro Pascal, 75, and they together build a residency in a very cold place, and this will be their residence nil rate band, their allowance. And in this case, we have again 2 people, and for a couple, it will be double the amount, so it will be 350,000. And for every 2 pound that exceeds 2 million pounds, the residence nil rate band will be reduced with 1 pound. So in this case, we have 2.5 million, and if we subtract, then we will have 500,000 excess. And we remember that our initial residency nil rate band is 350,000. We need to understand how much it will be reduced. And now the taper formula will be following. The taper reduction is the half of the excess. So half of this excess amount, half of 500,000 pound, will be 250,000, and our residence nil rate band will be reduced with this 250,000, and we will have only eventually 100,000 of nil rate base. So now let's continue our calculations. We have 2 things to calculate: how much tax should be paid on the house and how much tax should be paid on this 800,000 cash of gift. So the first thing that we do, we're applying our nil rate band to the failed PET. It's the 800,000 from 4 years ago. Since it's not more than 7 years, we still need to apply tax, but not 40%, but 32, as we discussed earlier. 4% is 4 year is 32%, and this will be our first calculation. From 800,000, we will take out 650,000, which is our nil rate band of 2 parents together. So this was the usual nil rate band of 325,000, which is doubled, and we're reducing from 800,000 this first part. And everything what remains is 150,000, and we will tax it with 32%. And the person who receives this 800,000, their child, for example, they should pay 48,000 on that cash amount. And now we are coming to the tax of the estate. So we don't have any usual general NRB nil rate band left, because we have spent all nil rate band of the 650,000 on the 800,000 cash transfer. And what we have available is residence nil rate band, which we have calculated that is 100,000 from this previous calculations, because excess of this 500,000 will reduce the residence nil rate band of 350,000 with 250,000, because we're halving this 500,000, and we will be left only with 100,000. And what will happen here? That this 2.5 million will be reduced with residence nil rate band with 100,000, and we will have 2.4 million to tax. And inheritance tax will be 40%, the full percentage on 2.4 million, and we will have 960,000 as tax. And the next amount, we need to add this 48,000 from the cash that we have received, and the total inheritance tax will be 1,008,000. If another assumption is that, like, potential alternative, what could have happened if this 800,000 was not transferred by one parent but was split 400k each. Although I don't know what this would change, but if it was made, for example, 7 years before the death, then the NRB would be much lower or nil, and we wouldn't have this 48,000. Also, if the estate were less than 2 million, we wouldn't have this 2 million excess rule, and the full 350,000 R and RB could apply the residence nil rate band for 2 parents. Each of them is under Celsius and Pedro Pascal to get a 170,000, and that could also reduce the tax amount. This first part was really heavy with the rates and exceptions and nil rate bands. That's why let's finish this video and we will continue the rest of the inheritance tax with our next video. Thanks for watching and see you in the next episode.